Hello everyone, I hope you're well and doing great. It's me again, Danyal Talebpour, and now we're going to start the 5th chapter of this book. You see, the previous chapters, 1 to 4, was, for example, for records, financial statement, everything was mostly for service performing companies or businesses. But from now on, we're going to discuss merchandising operations. It's something new. We have new terms, new accounts. So I'm going to need your full attention on this because it's very important to understand this chapter. And I'll be with you for the first part of this chapter. Let's see that what are merchandising operations? Merchandising is the business activity of buying and selling products rather than services in the previous chapters. And accounting for merchandising operations are a bit different from the rest. And so it requires us to deal with these balance sheets and income statement items. First, for a balance sheet, we have inventory, which is an asset. It's new. And for income statement, we have sales revenue and cost of goods sold. Cost of goods sold, also abbreviated as CGS, is an expense. Next, in this page, it's the operating cycle of a merchandising business. And as I told you earlier, it's a bit different from the accounting cycle. The operating cycle, it usually begins when the merchandiser buys inventory, he pays cash, and then the company sells the goods to customers and then collects the cash if the selling was on account. In any case, let's see, there are two different accounting systems for inventory systems. The first one is perpetual system, and the next one is periodic system. And now let's see how the periodic system works. A system in which the business does not keep a continuous record of inventory on hand. And when the end of the period comes, it makes a physical count of on-hand inventory and it uses this information to prepare the financial statement. But for perpetual system, the business keeps a running record of inventory and of course for cost of goods sold as well. And also inventory counted at least once a year. These are the differences between these two systems. First, we're going to examine accounting for inventory in the perpetual system. First, we usually had this transaction when the merchandiser purchases an inventory. It's the first step. So we're going to debit our inventory because it's an asset. We acquired an asset. And then we're going to credit our cash or accounts payable. It's an asset transformation. And this is an example as you see here. Suppose Austin Sound paid $700 purchase of inventory. To illustrate the purchasing process, receives the goods on May 30th. So on May 30th, our inventory is debited for $700. And of course, our accounts payable is credited for the same amount. A very important term in this chapter is purchase discounts. You see many businesses and companies offer their customers a purchase discount for early payments if the customers pays the debt earlier than expected. For example, credit term of 3%, 15, net 30 days. This phrase, as you see here, it means that company may deduct 3% of the total debt if the business, the customer, pays within 15 days of the invoice date. Otherwise, the full amount, net, is due in 30 days. So if our customer doesn't pay in the discount period, he or she has to pay the full amount in 30 days. And these credit terms can also be expressed as 3 per 15, N per 30. In term of N per 30, it means that the discount offered and payment is due 30 days after the invoice date. So for the first condition, if the business pays within the discount period, we're gonna debit our accounts payable, and then we're gonna credit our cash and inventory accounts. But if the business pays after the discount period, we're gonna debit our accounts payable, and then we're gonna credit our cash because the full amount must be paid. Now let's see how this works in case of an example. Suppose Austin Sound paid within the discount period. So on June 10th, accounts payable is debited for $700. Then we're gonna deduct and subtract the 3% of the accounts payable of the debt. So our inventory is credited for $21. And of course, our cash is credited for the rest of the amount. So as you see here in the T account for inventory, on May 30th, we had a purchase of $700. Then $21 were deducted because of the discount. So the balance amount will be $679. But if Austin Sound pays the invoice after the discount period, for example, on June 24th, our accounts payable is debited for $700 and our cash is credited for the same amount. The customer must pay the full amount. In this page, here's another term, purchase returns and allowances. Sometimes businesses allow their customers to return the merchandise that is defective, damaged, or otherwise unsuitable. And sometimes the seller can deduct an allowance from the amount the buyer owes. And both purchase returns and purchase allowances, they decrease the buyer's cost of the inventory. Here, you see the entry for this matter. Cash or accounts payable or accounts receivable will be debited, and inventory will be credited. For example, one DVD player is purchased by Austin Sound was damaged in shipment. So on June 3rd, our accounts payable is debited for $100, and of course our inventory is credited for another $100 because they returned, so our inventory decreases. In this page, this is a stop think, an example. It says that on September 15th, Austin Sound purchased $1,000 of merchandise on account, which turns 2 per 10 and per 30. Austin returns $100 of merchandise for credit on September 20th, then makes payment in full on September 25th. Journalize these transactions. The first transaction, the first entry, was for purchase on September 15th. So our inventory is debited for $1,000. And of course, our accounts payable is credited for the same amount because it was on account. I'm sure you all know that. Then for the second one, the second entry, it was returned. The inventory was returned to the customer. So our inventory is debited for $1,000. For our accounts payable is debited for $100, but our inventory is credited for $100. It's exactly the opposite of the upper entry as you see here. As for the final entry, the third one, we have a payment of $882 because it was paid during the discount period. So the 2% must be deducted from accounts payable, which was $900. So we're going to debit $900 for accounts payable, and then we're going to credit cash and inventory for these amounts as you see here. The next term is transportation costs. The transportation cost of moving inventory from seller to buyer, it could be significant. For example, 2 different countries, 2 different continents. it could be very high, the cost. So the purchase agreement specifies FOB terms to indicate who pays the shipping charges. FOB means free on boards. When the shipments boards on the transportation vehicle, it could be a car, a ship, or maybe a airplane, doesn't matter. It means that this piece of land, it's free. No country, no business owes it. So we have two different conditions in this matter: FOB shipping point and FOB destination. For FOB shipping point, the seller passes to buyer. The title passes to buyer. So the buyer is in charge, is responsible for the shipment until it arrives to its destination. And when it arrives, the buyer pays cost of transportation. But if we have FOB destination, the seller pays cost of transportation. So obviously, the seller is in charge of the shipment until it arrives its destination. When it arrives, the title passes to buyer. Suppose Austin Sound pays a $60 shipping bill. So in this matter, we're gonna add this expense, this shipment expense, to the inventory. So our inventory increases for $60. So we're gonna debit this amount. And of course, our cash decreases, is credited for $60. It is for payment of freight bill. And as you see here in the T account for inventory, first on May 30, we had purchased $700 on the previous transactions. Then we returned $100. And now we're gonna add another $60 because of freight in. The net cost, the balance amount will be $660. The next transaction says a 5,000 purchase of goods coupled with a related freight charge of $400. So on May 2012, our inventory is debited for $5,400 because we added the freight charge of $400 as well. And obviously our accounts payable is credited for the same amount. In this page, here's another stop thing, and it's exactly like the preceding one, but with freight in. On September 15th, Austin Sound purchased $1,000 of merchandise with $1,800 freight added. Total of $1,080. Then Austin Sound returns $100 of the goods for credit on September 20th and pays the accounts payable in full on September 25th. Journalize these transactions. The answer is 3 separate entries. The first one is for purchase, the next one is the return, and finally we have the payment. For the first one, we're gonna debit our inventory for $1,080, and then we're gonna credit our accounts payable for the same amount, obviously. But for the return, it's exactly the opposite of the upper entry. We're gonna debit accounts payable, $100, and then we're gonna credit our inventory for the same amount. Finally, for our payment on September 25th, accounts payable is debited for $980, and then we're gonna subtract our discount amount. It is $18. We're gonna credit our inventory for $18, and then we're gonna credit our cash for the rest of the amount. In this page, we're gonna discuss sale of inventory. After we purchase our inventory, it's time to sell it. So after a company buys inventory, the next step is to sell the goods, obviously. The amount a business earns from selling merchandise inventory is called sale revenue. It could also be abbreviated as sales. And a sale also creates an expense, as you all know. It's called cost of goods sold. CGS. And as the seller gives up the asset inventory, we have CGS. In other words, as you remember, I discussed this matter with you, that when an asset becomes an expense, it is consumed. It's the exact same for here. So our cost of goods sold is the entity's cost of its inventory that has been sold to our customers. And you need to know that cost of goods sold is a merchandiser major expense. It's very big and huge. So we have two different entries. First, for our cost of goods sold, we debit our CGS, and then we're going to credit our inventory. And finally, for the revenue, we're going to debit our cash or accounts receivable. It's obvious. And finally, we're going to credit our sales revenue. Here's an example. It says here, sales of retailers such as Austin Sound, grocery stores, and restaurants are often for cash. So, cash sales of $3,000 are recorded by debiting cash and crediting sales revenue, as I explained to you in the previous page. We're going to debit our cash amount for $3,000, and then we're going to credit our sales revenue for the same amount. Suppose these goods cost the seller $1,900. This is for our CGS. Our cost of goods sold is debited for $1,900, and then our inventory is credited for the same amount. On this page, we're gonna discuss sale on account. So, for example, if a $5,000 sale on account is recorded, as you see here, our accounts receivable is debited for $5,000, and then our sales revenue is credited for the same amount. This is for sale on account. And then suppose that the cost of goods sold here is $2,900. So the entry will be CGS debited for $2,900, and then inventory is credited for the same amount. And finally, when the due comes and the customer must pay, our cash is debited for $5,000, and then our accounts receivable is credited for $5,000. It's an accounts transformation. As previously told you, we had purchase returns and allowances. Now we're going to discuss it for sales returns and allowances. And as we just saw, the purchase returns and allowances, and of course the purchase discounts, they decrease the cost of inventory purchases. And exactly the same way, sales returns and allowances and sales discount, which are contra accounts to sales revenue, they decrease the net amount of revenue earned on sales. So first, we're gonna debit our inventory, and then we're gonna credit our cost of goods sold. This is for returns. And then the second entry, sales returns and allowances are debited, and obviously cash and accounts receivable or accounts payable are credited. Here's another example. On July 7th, GVC sells stereo components for $7,200 on credit terms of 2 per 10 and per 30. These goods cost GVC $4,700. This is the CGS. Anyway, on July 7th, it was purchased, so our accounts receivable, it was selling, sorry, our accounts receivable is debited for $7,200, and our sales revenue is credited for the same amount. This was a sale on account. Then the next entry is for our CGS. Our cost of goods sold is debited for $4,700, and then our inventory is credited for the same amount. Suppose GVC grants $100 for allowances. So our sales returns and allowances is debited for $100, and then our accounts receivable is credited for the same amount. On July 17th, it's the last day of the discount period, GVC collects $4,000 of this receivable. So our cash is debited for $3,920, and our sale discount, the 2%, it's deducted from the accounts receivable. It's $80. So our account receivable, which was $4,000, is credited in the end. Suppose that GVC collects the remaining $2,500 on 28th July. So our cash is debited for $2,500 and our accounts receivable is credited for the same amount. As you see here, it's a T account for accounts receivable. On July 7th, we had sales for $7,200. Then we had a return worth of $600, an allowance for $100, and then we had two collections, $4,000 and another $2,500. The balance amount will be zero, obviously, because we have no more accounts receivable. And finally, we're gonna evaluate our profitability. Our sales revenue, cost of goods sold, and gross profit is engaged in this matter. If we subtract our cost of sales from our sales, we're gonna have gross profit. And if we subtract our expenses from this gross profit or gross margin, we're gonna have the net income or net loss, as you all know from the previous chapters. So if Amazon's cost to purchase a DVD is $15 and Amazon sells the DVD for $20, the Amazon gross profit per unit is $5 because we subtracted our cost of goods sold for DVD, which was $15, from the $20 that was sales revenue. The resulting amount will be $5 for gross profit. That was my part for this lecture. I hope you all liked it. And now my dear friend Kian will continue the rest. Have a nice day.
Thank you very much, Daniel. Hello, everyone. I am Kian Mahmoudpour. I am going to be with you in the second part of chapter 5. And so let's start. Here on this page, we have sales discount. But what is sales discount? Imagine that one company sell inventory to another company. And our company said that you should pay your liabilities in next 30 days. But if you pay it in next 10 days, I can give you 1% discount, 2%, or 3% even. It depends on the policy of that company that determine the discount. And for this entry, if the customer pays within the discount period, we make cash on the debit side, we put sales discount on debit side, and accounts receivable on the credit side. Sales discount is a account that it has the normal balance of debit. So for the entry and record this account, we can put it on the debit side. But if the customer pays after the discount period, we put cash account on the debit side and accounts receivable on the credit side. This was the accounting for inventory in perpetual system that we talked about. Daniel and I talked about perpetual system. But in accounting, we have two systems. The first one that we completely talked about it was perpetual system. That in perpetual system, we have cost of goods sold, we have inventory accounts, and all the periods we can account, and we have account, it means inventory. But in periodic system, we don't have any cost of goods sold and inventory, and we wait until the end of the period. And after that, we count amount of the inventory, and after that we can make a entry, make a journal entry. And another point in periodic system is that in the entry, instead of inventory, we have purchase. So if we purchase of inventory in periodic system, we have purchase on the debit side, as you can see here, and cash or accounts payable on the credit side. If we paid exactly in that moment, we have cash, but if we paid after that, we have accounts payable. Another entry is purchase returns and allowances. Cash, we can make debit cash, accounts payable or accounts receivable on the debit side, and purchase returns and allowances on credit side. And about transportation costs, we make purchase account debit and cash or accounts payable credit. But what about purchase discounts? I have to mention that purchase discounts and purchase returns and allowances have their normal balance of credit. So when we want to make a journal entry for these accounts, we should put them on the credit side. As you can see here, we make credit purchase returns and allowances here, and here on this page, purchase discounts, we put it on the credit side. So if the businesses pays within the discount period, we make debit accounts payable and cash and purchase discounts credit. We make them credit. But if the business pays after the discount period, we have accounts payable on the debit side and cash on credit side. But what about sale on inventory? Sale on inventory, if you remember, Danyal completely explained it, that in perpetual system, we have two entry for sale of inventory. But instead, in periodic system, we have only one of these entry, and we record only one entry. Here, as you can see, we receive cash, or we will receive it in the future, that we have accounts receivable, and we have sales revenue. We don't have any cost of goods sold. We don't have any inventory in periodic system. But what about sales returns and allowances? Sales returns and allowances, exactly like perpetual system sales returns and allowances and sales discounts, they have normal balance of debit. And we record sales returns and allowances on debit side and cash, accounts receivable or accounts payable, on credit side. If we pay the cash exactly in that moment, we can make cash on credit side. If our pledges decrease, we can put accounts receivable on the credit side. And finally, if we pay it in the future, we can make accounts payable on credit side. But what about sales discounts? If the customer pays within the discount period, we have cash and sales discount on the debit side and accounts receivable on the credit side. But if the customer pays after the discount period, we have cash on the debit side only and accounts receivable, because the customer pays after the discount period, so we don't give him or her any discount. And now here we have example about Amazon, Amazon.com, that suppose Amazon.com engaged in the following transactions during June of the current year. In first transaction in June 3, Amazon purchased inventory on credit that in 30 days, but in 10 days 1% for $1,600 in June 3. So, and the question required is we have to make a journal entry for all transactions. In first transaction, we should make inventory on debit side and accounts payable on credit side. And the digit of these transactions, it was $1,600. The next transaction in June 9, Amazon returned 40% of the inventory purchase on June 3. It was defective. So for this transaction, we have accounts payable. The 40% of 1,600, we make accounts payable on debit side because it decreased, and inventory even decreased, 640 on credit side. The next transaction is the Amazon sold goods for cash, 920, cost 550. We have sale. So in perpetual system, we have two entry. And I have to mention that in this chapter, we only cover the perpetual system and we cover periodic system in the next chapters. But here we only introduced some of the entry of periodic system, and we will talk about it in the next chapters. So we have two entries. The first one is cash on debit side and sales revenue on credit side. And the number of this transaction, because we sell it, it was 920. But we have another entry, and it is the cost of goods sold, that the question gave us the information for the number, and it was 550 cost of goods sold on debit side. And you know, cost of goods sold has normal balance of debit, so we make it debit. And inventory on the credit side, 550. The next transaction is Amazon goods for 5,000. Credit terms were in 30 days. If paid in 15 days, you can get 3% discount. So for transaction in June 15, we should make inventory on debit side $5,000 and accounts payable $5,000 on credit side. The next transaction is Amazon paid $260 freight bill on goods purchased. As you know, we should make inventory 260 on debit side and cash 260 on debit side, and cash 260 because we paid cash on credit side. The next transaction in June 18, Amazon sold inventory on credit terms of 10 days, 2%, net 30 days, $2,000, and the cost of this transaction was 1,180. So for transaction 18, in June 18, we have accounts receivable $2,000 on debit side and sales revenue $2,000 on credit side. And even we have another entry because we sell inventory. Amazon sell inventory. And in sell inventory in perpetual system, we have two entries. Cost of goods sold 1,180 on debit side and inventory 1,180 on credit side. In June 22 year, yes, Amazon borrowed money from the bank to take advantage of the discount offer on June 15 purchase. Signed a note payable to the bank for the net amount. And we have another entry for June 24. Amazon paid supplier for goods purchased on June 15 less the discount. So we have two entry, and for June 24 we can put cash account on debit side because we received money from the bank and the amount was 4,850, and notes payable because we signed the pledge 4,850 on credit side. And another entry transaction for June 24, it was accounts payable $5,000 on debit side because it decreased, and inventory and cash 154,850. In June 18, yes, in June 28, Amazon received cash in full settlement of the account from the customer who purchased inventory on June 18, less the return on June 22. Also, for this transaction, we have cash and sales discount on debit side. Cash it was 1,176 and sales discount 24 on debit side, and accounts receivable 1,200 on credit side. And finally, the last transaction is Amazon paid the amount owed on account from the purchase of June 3 less the June 9 return. So in June 29, we put accounts payable on debit side 960 and cash 960 on credit side. And finally, our transaction was over. Yes. On the next page, on this page, we can see adjusting and closing accounts of merchandiser. A merchandiser, after that, that make a journal entry, it should make an adjustments and closing their accounts. A merchandiser adjusts and closes accounts the same way a service entity does, but the only difference between this chapter and chapter 4 for worksheet and closing and even adjustments, it is the inventory. In merchandiser have first sales revenue, sales discount, sales returns and allowances, and even in worksheet we have inventory that it is very important. So let's cover these items. And I have to mention that we have another adjusting entry for adjustments, and it is inventory. Look, when in perpetual system, if we have the digit and number that inventory in the first of period and the end of period. If the end of period, the digit and number of inventory increase, we have inventory on debit side and cost of goods sold on credit side, but vice versa. If we have any inventory shrinkage or decrease, we record the adjusting entry, cost of goods sold on debit side and inventory on credit side. And here you can see in December 31, cost of goods sold, we put it on debit side $300 and inventory $300 on credit side. And finally, we can preparing and using the worksheet. In most accounting systems, a single operation combines trial balance amounts with the adjustments. The adjusted balances go directly to the income statement. And as you remember from chapter 4, in worksheet, we have the accounts title column, unadjusted trial balance column, adjustments column, adjusted trial balance, income statement, and finally balance sheet columns. And here we prepare, on this page we prepare worksheet for Austin Sound Center. At first line we have the name of the company, at second line we have the name of the document that we want to prepare it, and finally the time period that we want to prepare this document, I mean worksheet. We have cash, as you can see, after that liabilities, then we have capital, then withdrawals, and after that we don't have service revenue. Here in merchandiser we have sales revenue, sales discount, and sales returns and allowances. And sales revenue and all revenues have normal balances of credit. But about sales discounts and sales returns and allowances, they have normal balance of debit. And even we have cost of goods sold that we didn't have in the last chapters, that it has the normal balance of debit. And finally, expenses. So we put all of these items and amounts, accounts titles for unadjusted trial balance adjustments. Here, because of the space of this page, we didn't bring adjusted trial balance, but it is not different because these amounts after that we compute it exactly directly transferred to income statement columns and balance sheet column. So all assets, we put them on balance sheet column, and they have the normal balance of debit, so we put it on debit side. And here depreciation on credit side and accounts payable on credit side. But the difference between this worksheet is here. Sales revenue on credit, because all revenues are credit. Sales discount and sales returns and allowances on debit side. They don't have any adjustments, and after that directly they transfer to income statement. And finally, if we compute these all items, we can our result will be net income or net loss. But here in this case, for Austin Sound Center, we have net income, and the digit and number of the net income, it was $53,850. Yes. So after journalizing the worksheet and adjustments, and after all these steps, we have closing entry. The first step to closing entry, we make debits the revenue accounts for their ending balances. Then the offsetting credit transfers the sum of total revenues to income summary. This amount comes directly from the credit columns of the income statement. It means that we have net income or net loss. The result of the T account for income summary, it is net income or net loss. The second closing entry credits cost of goods sold, the control revenue accounts, it means sales discounts and sales returns and allowances, and all the expense accounts. These amounts come from the debit column of the income statement. And the last two closing entries close net income to the capital account, and also close withdrawals into the capital account. And here we have an example for Austin Sound's adjustment data at December 31, 20x5, and that we have to make a journal entry for these adjustments, and after that we close the accounts. The first one is interest revenue earned but not yet collected, $400. So the first entry, we make interest receivable debit and interest revenue credit, $400, that we completely talked about it in chapter 3. These adjustments, inventory on hand, $40,200. So I told you this adjusting entry exactly in this chapter. I told you if the number of inventory in the end of the period is decreases, we should put cost of goods sold on debit side and inventory on credit side. Why? Because inventory has the is one of the assets. So if you make it credit, it means that it decreased. So here in the end of the period, the inventory count decreased. So we put inventory on credit side, $300, and cost of goods sold, $300 on debit side. The next transaction is supplies on hand, $100. Supplies expense and supplies, $550. Here we need supplies that it used up. Look, $650. We subtract 100 from 650 because we need supplies used up. In transaction D, prepaid insurance expired during the year, 1,000. So insurance expense and prepaid insurance, 1,000. in transaction E, depreciation 600, and depreciation expense and accumulated depreciation 600. Exactly, it is like service businesses. And the next one, unearned sales revenue earned during the year 1,300. Unearned sales revenue 1,300. And accrued wages expense 400 that we have, which is expense and wages payable. And the last one is accrued interest expense 200. That here we have interest expense and interest payable. After that, we should close our accounts. Sales revenue and interest revenue and all revenues have the normal balance of credit. So if you want to close it, we put it on debit side, and the opposite side will be always income summary. And the digit is 170,300 for this, for the first entry. And in second entry, we have sales discount, sale returns and allowances, cost of goods sold, and all expenses on credit side. Why? Because all these items that we completely explained it, they have normal balance of debit. So if you want to close it, we put it on credit side, and the opposite side will be always income summary. And the number is 116,450 on debit side. And finally, we close income summary to capital, and here you can see our net income that we completely talked about it. The result of net income in T accounts, gave it us, it can give it us the net income or net loss. Here in this case we have net income. It means that we have the balance of credit. So if you want to close this income summary, we make it debit, and the opposite side that we close it to capital is capital. And the number is 53,850. And finally, the last one, we close withdrawal to the capital. Withdrawal has the normal balance of debit. So if you want to close it, we put it on the credit side, and the opposite side will be always capital. And the number of these withdrawals of this transaction is 54,100 and $54,100. Thank you very much. Thank you for your attention. I hope you enjoyed my presentation. I hope it was useful. Thank you. My friend Sama is going to explain the next part. Thank you very much.
Hello guys, I'm Zandi. I'm back again. I'm with you the last part of the chapter. So let's do it. Preparing a merchandiser's financial statements. The income statement begins with sales, cost of goods sold, and gross profit. Then come the operating expenses, which are those expenses other than cost of goods sold that occurs in the entity's major line of business. Many companies report operating expenses in two categories: selling expenses and general expenses. Selling expenses are expenses related to marketing the company's product, sales, salaries, sales commissions, advertising, depreciation, rent, and utilities on stores building, and also delivery expense. And general expenses include office expenses such as the salaries of the company president and office employees, depreciation, rent, utilities, and property taxes on the home office building. Gross profit minus operating expenses plus any other operating revenues equals operating income or income from operations. Operating income measures the result of the entity's measure ongoing activities. Other revenues. Other revenue that is outside the main operation of a business, such as a gain on the sale of plant assets. Other expense that is outside the main operations of a business, such as a loss on the sale of plant assets. And statements of owner's equity. A merchandiser's statements of owner's equity looks exactly like that of a service business. And balance sheet. If the business is a merchandiser, the balance sheet shows inventory as a measure of current assets. Service businesses usually have no inventory. Here it is, Austin Sound Center. The income statement of Austin Sound Center, which begins with sales revenue, then less sales discounts, and also sales returns and allowances, which gives us net sales revenue, which the amount is 165,900, and we should minus cost of goods sold, that that gives us the gross profit, which is 75,100. And then we have the operating expenses, and after that, other revenue and expense, which gives us the net income amount, which is 53,850. That amount of the income statements goes to the statements of owner's equity of Austin Sounds Company. Here, we should add net income to the capital December 31, 2004, and less withdrawals. That gives us the amount $25,650, which is capital December 31, 2005. This amount goes to the balance sheet. Here it is the Austin Sound Company balance sheet at December 31, 2005. On the left side, we have the assets. On the right side, we have liabilities and owner's equity. You can see for assets, we have furniture and fixture. So we should less accumulated depreciation to this amount that give us 30,200. We should add this amount to total current assets. That the total assets equal $86,550. And on the liability, on the right side, we have the liabilities and owner's equity. Those amount gives us $83,550. These two amounts are equal. Here it is, the multi-step and single step. If you remember, in the balance sheet, we had two formats. The first one was report format, which we had assets on top, then liabilities, and after that, owner's equity on the bottom. And the other format was the account format, assets at the left, liabilities and owner's equity at the right. So here, for income statements, we had two formats again, the multi-step format and the single-step format. The multi-step format is more popular. So, the multi-step format lists important subtotals. In addition to net income, it also reports gross profit and income from operations. This format reports a merchandiser's results of operating especially well because gross profit and income from operations are important to investors. And the next format, which was single-step income statement. The single-step format groups all revenues together and all expenses together without drawing any subtotals. The single-step format clearly distinguishes revenues from expenses. This format works well for service entities because they have no gross profit to report. Here you can see the income statement of Austin Sound Center, which begins with revenues and the expenses. And the net income, which we had it here, is $53,850. Here we have the gross profit percentage. Merchandise inventory is the most important asset for a merchandising business. Owners and managers use several ratios to evaluate operations, among them the gross profit percentage and the rate of inventory turnover. The gross profit percentage is a key decision tool. Highlights gross profit, which is net sales minus cost of goods sold. The gross profit percentage, also called the gross margin percentage, is one of the most careful watched measures of profitability. Here, you can see the gross profit percentage of Austin Sounds Company. For the formula is gross profit percentage. At the top, we have gross profits divided on net sales revenue. The gross profit amount is 75,100 and net sales revenue is 165,900. So the gross profit percentage of Austin Sound is 45.3%. Here you can see cost of goods sold and gross profit of three companies, Austin Sound, Target, and Amazon. You can see the amounts between you can see the comparison between the amount of cost of goods and gross profits. The ratio of inventory turnover. Owners and managers strive to sell inventory quickly because the inventory generates no profit until it's sold. The faster the sales, the higher the income, and the slower the sales, the lower the income. Inventory turnover, the ratio of cost of goods sold to average inventory, indicates how rapidly inventory is sold. It is computed as follows. You can see inventory turnovers equal cost of goods sold and divided on average inventory. This average inventory comes from the beginning inventory plus ending inventory divided on 2. So for Austin Sound, the cost of goods sold is 90,800 and the beginning inventory is 38,600 and the ending inventory is 40,200. Divided on 2, it gives us 2.3 times per year. A turnover rate of 2.3 times per year suggests that Austin Sound is not very efficient. You can see for the Austin Sound and Amazon.com from January to December. For Austin Sound, we have 2.3 times per year, and for Amazon, we have 14.6 times per year. It is more than Austin Sound. Stop and think. Here we have a small example of a software company. Here we have the informations about the beginning inventory, ending inventory, and cost of goods sold. Inventory turnover is cost of goods sold divided on average inventory. So cost of goods in this company is $20,349 and the beginning inventory is 1,856 and the ending inventory is 2,445 divided on 2 gives us 9.5 times per year. So let's do the comprehensive example. This example is about Janking Distributing Company. Here we have the transactions A to G, and we're gonna work on them. And here it is the requirements that the example want us, like enter the trial balance on worksheet, like journalizing, the adjusting, closing entries, and preparing financial statements also. Here it is the trial balance of Junking Distributing Company at the beginning accounts with their amounts. Would start with cash and accounts receivable to interest expenses, and the total amounts are equal, which is 476,420. The first transaction of the company is supplies used during the year 2580. So the entry is supplies expense and supplies, and their amount debited and credited with that specific amount. The next transaction said prepared rent in force $1,000. If you look at the trial balance of the company, we had prepared rent $6,000, which is debited. So the entry should be rent expense, prepared rent for $5,000. So we should go to the next transaction, which said unearned sales revenue still not earned 2,400. If we go back to the last slide, for unearned sales revenue, we had the entry was we had 3,500, so we should minus 2,400. So it gives us 1,100, which is debited, and the credit amount is sales revenue. And the next transaction said depreciation. The furniture and fixture estimates useful life as 10 years, and they are expected to be worthless when they are retired from service. So the entry is like that. Depreciation expense 26,500 divided on 10. So it should be 2,650, and the accumulated depreciation, which is 2,060 and 650. And the next one said accrued salaries 1,300. So the salary expense, salary payable 1,030 and 300. And the next one, accrued interest expenses, which is $600. So interest expense, interest payable, $600. And the last one said inventory on hand, $65,800. So the entry is inventory, which we had it on the trial balance for inventory. It was debited 60,500. So here for the entry should be, we should minus this amount to the beginning. That gives us $5,300 debited for inventory and 5,300 credited for cost of goods sold. And here we have the worksheet of Junking Distributing Company. Year ended December 31, 2005. The first item references the next column account title, then the trial balance, which amounted at the beginning of the company, then the adjustments, the entries that we worked on it, and then the income statements, which includes expenses and revenue, and then the balance sheet with assets, liabilities, and owner equity. It starts with cash and ends with the interest expense. So if you look at here, for example, for Cost of goods sold, we have 171,770, which is debited, and in the adjustment, it's credited 5,300. So we should minus this amount to this. It gives us 166,470 dollar amount. And for example, for rent expense, we have $7,000, which is debited, and the adjustment is debited for $5,000. So you should add these two amounts. That we have the $12,000 in the income statement. If you can see, income statement amount, the debit amount and credit are not equal, so we should equal them and we should balance it with 52,250. So this is the net income of the company. Here it is, the closing entries. We want to close the accounts. Sales revenue was credit, so we should debit it here for the amount 347,800, and we should close it with income summary. And the next entry is closing the discount, the returns and allowances and cost of goods and all the expenses to income summary. And if we add these amounts together, if we sum this, it gives us 295,550. So after that, the next entry should be closing the income summary. We have the income summary here credited this amount and here debited. So if we minus these two, it will be 52,250. We should close it with the capital, Janking capital. After that, the last entry should be closing the withdrawal account. The withdrawal amount was $48,000, so we should close it with Janking capital. Here it is, the income statements of Janking. Starts with revenues, less than the sales discount and the sales returns and allowances, gives us net sales revenue, which is this amount, and we should less cost of goods sold to have gross profit. And then the operating expenses, and after that, other expenses. Here we have interest expense. So the net income is 52,250. This net income goes to the statements of owner equity. Statements of owner equity, we have the capital balance at December 31, and we should add net income and less withdrawals. That is the net. That is the capital December 31, 2005, which is $27,930, which goes to the balance sheet. In the balance sheet of Janking Distributing Company, we had the assets, liabilities, and owner equity, and the capital, which we had it on statements of owner equity, which should be here. And for the assets, we have furniture and fixture, so we should, and we had accumulated depreciation, so we should less accumulated depreciation. That gives us 2,650. So the total amount of assets is 113,570. So it is the total assets equal to total liabilities and owner's equity. That was all. Thanks, guys, for your attention, and bye.
Thank you very much, Sama. Thank you, everyone, for your attention. I hope you enjoyed this chapter. Thank you.
Thanks, Kian and Sama, for your effort and energy. And now that this chapter has ended, for the next chapter, chapter 6, we're going to discuss this matter by explaining inventory costing methods and inventory issues. These are the email addresses below. I hope you all enjoyed it. And of course, this is a very important chapter because it's the basic of merchandising companies. So you're going to need to get a full grasp on it. See you next time. Take care.